Oh, 6:30. Good evening, ladies and gentlemen. Thank you for joining the wonderful team. We're super excited that you're spending your spring evening with us talking about tariffs. But it is interesting how something that we don't often think about has become quite topical. We've been asked lots of questions about it. Waleed actually created this wonderful presentation, and full credit to him for doing so. And yet we realized if we were just doing this in client meetings, it was going to take us forever to get through our slide deck. And as you know, as the current president waffles a little bit about whether tariffs will come in or not, it may or may not be relevant. So we prepared this slides for you. We'll also do a recording that we'll share the link with you as well afterwards. We didn't think that this should take much more than about 30 minutes. So we've left a chance for Q&A as well. And Joel is running the panel. So if you do have questions throughout as we're talking, by all means, you can put it into the chat. It won't distract our main speaker. We won't be able to see that till we go to Q&A, but it would be really helpful if there's some things. We do have a number of questions that clients have come up with that we think will be good to share with you. So we're really looking forward to running through this with you this evening. I want to talk about the team a little bit. Joel, as you know, is now 10 years, and Joel is a brand new dad, if you can believe it. And he actually looks pretty good considering the amount of sleep he's not getting. Wally is 17 years now, and he's a professional engineer, but please don't hold that against him. He's a really nice guy who can talk technical things. And he, as I said, the mastermind who put this whole thing together, which is great. Michael and Michelle are no longer babies, although sometimes they still want daddy's attention. And my name's Trevor Drew. I've been 26 years at this, a long time. And my little guy is not so little. He turns 21 here just next month. And it's sort of interesting how time goes on. But tariffs and you, tariffs have always been around. So we do want to talk about it. We're going to take turns rotating through. And I think Joel, though, is going to talk about why the three of us are here and interesting what we believe in terms of the financial plan should allow you to do, which I think is going to be part of the themes of tonight. So I'm going to click and then turn that over to Joel. Just slide in. There we go.
Well, thank you so much for the lovely introduction, Trevor, and thank you everyone who's attending here today. So this is what we like to do for our clients, and essentially what we call it is the financial roadmap. We like to draw a roadmap from where our clients are today to where they want to be in retirement, and then take all the factors into consideration along the way, whether that's paying down your mortgage, saving for your kids' education, estate planning, and creating wealth for generations. And the nice thing about this is that with our diverse amount of expertise here at each stage of the financial roadmap, we have a specialist. So the wealth accumulation in the early career, starting to really build up assets, that's where I come in for the most part. We get into the mid-career, the 30 to 55 range, and that's where Wally specializes with business owners and a lot of other specialties there. And then Trevor really focuses on the retiree market and making sure that all of these parts of your life work together and we can create wealth for generations to come. With that, I'm going to hand it over to Wally.
So we're here to talk about tariffs. Tariffs are not a new phenomenon. It's been around for a while. For the most part, it's been part of trade policies for centuries, and not just the US, but globally. Countries generally use it to protect their domestic industries, and it's a means of generating revenue. Now, why are we here today? There's been a lot of talk about Trump's tariffs, and what's that? 25% Canada, Mexico, 10% China. Household costs could be potentially 2,000. Now, even as of today, there have been some walkbacks on this. Now, what this does is that there's a lot of uncertainty and volatility in the market, and you might have experienced some of this already. Now, some of the short-term effects are higher consumer prices. We're beginning to see that even in Canada, there would be potential job shifts, but generally, what you see is increased economic uncertainty. Markets don't like unpredictability. Then we get a lot of short-term volatility. Now, one thing I want you to keep in mind as all this is going on is that, yes, there's a lot of disruption, but it's not necessarily destructive. With that, I'm going to hand over to Joel, who's going to talk a little bit about the long-term market and its resilience.
Awesome. Thank you, Wally. So as we've all seen, there's always an initial impact whenever there's uncertainty, as Wally was talking about. And what we usually see is markets will drop and react to geopolitical shocks. A few weeks later to months later, depending on the environment, historical data and statistics show that markets typically recover. Um, and within weeks of significant events. So this doesn't last forever. And from a long-term perspective, it comes back to the fundamentals of financial planning and wealth accumulation. I mean, it's scary, but reactive tendencies can lead to long-term losses. So our advice would be to stick to the plan at the end of the day, trust the fundamentals of financial planning, and make sure that you got your goals and you're following your goals and not straying too much, no matter what the noise out there is. So this next slide is an index chart showing the S&P 500 through 1956 to 2024. And as you can see, there's a lot of corrections that have happened, but we've always bounced back and recovered from these corrections. So it comes back to long-term planning. Our advice is to stay the course, understand that actively managed portfolios are structured to minimize volatility. So making sure you're not oversaturated in any specific sector, demographic, and make sure that your time horizon is accurate, your risk tolerance is right, and your goals are the same. Then you don't really need to make any drastic changes to the plan. And it comes back to an old statement saying it's time in the markets, it's not market timing. With that, I'm going to pass it over to Trevor.
We're so graceful. We're like penguins, actually, just moving gracefully in the background here. What Wally and Joel are both saying is exactly what's encapsulated in this slide. And it's really a simple slide. It really doesn't affect long-term performance. I'm going to show you this in a little bit more detail in a couple slides, but I think that's the biggest thing. And I want you to think back about the recent market events that we've had to endure. We had COVID. We had a big market correction during COVID. And that was a really interesting, hopefully once in our lifetime event. And yet, as long as we didn't panic and we were properly diversified, we did quite well. It's interesting how quick we can forget. 2022 was actually a negative year in the market. I don't know if there was a lot of explanations for that, but a few years out and it's already gone. I was looking at even some of this graphs, which I'll show you. They don't even have 1999 anymore on these things. That's not ancient history for us. We've been investing for that long, but it's already fading into the background. So when you look at why don't like geopolitical events affect the market long term, there's a really interesting theory that markets are fairly efficient. Well, they are. They have to adjust for that. So if tariffs are going to impact your company, you're going to have to change your pricing list at some point, and people are going to have to be aware of that. Economics resilience. You can see this in, I mean, in the city we live in, Calgary. We've gone through some booms and busts, and yet we do come back. As economies are robust enough, and especially when you go globally, to actually take some of this shock. Companies change. We all know that. We're all a part of that. I mean, we're using a webinar today with technology that's incredible. And if you've played around with AIs, you've actually seen some of this impact yourself. All of these things happen. And AIs, there's innovative responses that can sort of take some of this away. But when I said that geopolitical events don't affect it, I wasn't just whistling Dixie. You kind of have to turn your head sideways for this one, but I'm going to encourage you to do so. And to me, what's interesting is here's the market. This is again the S&P 500, 04 to 2023. I call that recent history, but others might think that's ancient history. Tsunami hits Asia. Wow, we've never seen one of those before. That was a big deal, and the markets did 14%. Dow Jones closes above 12,000 for the first time. What is the Dow at currently? 45? It's interesting. That's not that long ago. It was a 17.3% year. 2008, that is a really interesting year. That is the subprime crisis. That's when we thought everyone could get a mortgage. Apparently, they can't, and good fundamentals matter. Market did correct 33%. And that was interesting because I remember that time and literally holding clients' hands and saying, I know we're not down that much, but we are down. I'm thinking let's just hold on and diversify and come through, and away we go. 2014 in Alberta, oil drops below $60 a barrel. That was a panic for us, but not necessarily for the rest of the market. Anyone remember COVID? I'm actually doing my best to forget about it, but 2020, that was something that very few living people had ever experienced, was that level of pandemic lockdowns. And we had no idea. Like, it's very easy in the rearview mirror to say, oh, this was going to last a number of years. But people were talking 6 to 8 weeks, we might be back to normal at the time. And I was on a community association, and we just didn't know, should we let go of our staff? Should we hold on to our staff? Then we got subsidies. It was really difficult to navigate that. And yet the markets managed to and did very, very well as long as you stayed diversified. And the market value, as of right now, if you invested $10,000 in the S&P back in 2003, you have almost $45,000 as of last year. And 2024 was even better. So that is interesting. When we say reasons to stay invested, it doesn't mean, and you can see those fluctuations, and those fluctuations have heavy emotion. I'm going to talk about that in 2 slides. And then you take a breath, and you're like, this will not go off forever. Oh, no, I'm going to talk about that in, yes, 2 slides. If you've been my client for a while, or if you're new to the team, maybe Wally and Joel don't use this as much. This is one of my favorite little Lego block pyramids. It does look like Lego blocks, doesn't it? Here's what you need to pull out that I think is important. 7 out of 10 years, the markets make money. That's what it's telling you. Since 1948, oh, at least we're going back a little bit further. 7 out of 10 times, the market's actually ahead of the game. Now go into the Lego box a little bit more, and what do you notice? Especially if you go to the minus 30, minus 40, there's only one piece there. Plus 30, plus 40, there's five. Oh, so when it gains really big, it doesn't necessarily have to lose to do that. Okay, that's interesting. What about the minus 30 to minus 20? There's two Lego blocks there. Holy smokes, I think there's 12 in the next one. And then you can see they're not equal. They're not equal at all. Most years, not only does the market make money 7 out of 10 years, which is why it works for us long term, it actually disproportionately earns dollars. And if we can go through some of these fluctuations, if you want to look right at the top, just where 2023 is, 2020 is there. That was the COVID year. And remember how dramatic the market fluctuation was, because we'll come back and talk about paper losses in a second, or later in the presentation, I should say. But if you didn't panic and just held out for the end of a year, you had a really solid year actually through a pandemic. So the market has, I think what we're saying is weathered more than just Trump's piece. This is real. If we were dealing with computers, we would have convinced you already, and you'd be like, thank goodness I attended this seminar and I should not panic and I'll be done. But we're dealing with human beings. And I have a lovely wife, and she's my toughest client because anytime the markets go down, she is just in despair and nausea and dejected. I got these questions about what kind of competence do I have? I'm like, well, I guess other people listen to me. And yet it's funny, I don't get enough of the encouraged confident when the markets go up. The jubilation occasionally from her when she's looking at statements. It's a real piece. I see it in my own home life. I see it with clients when we do. Don't let emotions make your decisions for you. That's all this is saying. These emotions are natural. Feel them. If you remember last year, and Wally and Joel were sharing that we all share this, I told everyone double digit returns. You can smile. At some point, the markets are not going to be as good. I don't know where that is. Okay. But enjoy the good times as well. And we don't know sometimes if it was a good time or not until the end of the year. So the corrections in the middle are very, very, very natural in terms of that piece. So just the takeaways are geopolitical events happen. They happen all the time. We've experienced lots just in the last 20 years, and that cycle's not going to change. 7 out of 10 years, the markets make money. That's a really important key. And your emotions are okay. Just don't make decisions based on them. Wally?
So, what should we be doing in the short term? You might need to make budget adjustments. Research has shown that most people will get away with living on 80% of whatever they're spending right now. What that means is, on average, if you're having 4 glasses of wine a day, you might get away with three, thereabout. Um, you might also want to consider domestic alternatives. A lot of us are already doing that. The tariff situation has galvanized most Canadians, and we're looking at what would produce locally. These could end up being cheaper and may offset the price increases that we see from the tariffs. But the most important thing is to avoid reactionary decisions. Trevor already talk to you about panic. Um, it's important that we do not make long-term decisions based on short-term situations. So, how do you protect your financial plan? You want to stay invested. You hear this from me, from Trevor, from Joel. We've been saying the same thing for the last 25 years, and it has worked. Diversify globally. That's going to be the word of the day. Spread your investments across regions. US is in trouble right now. It shouldn't be too much of a problem if it's only 20% of your overall portfolio. Um, Now, mix asset classes. A little bit here, a little bit there. We can't be too focused on one sector. And we already do that with your investment plans. Now, build an emergency fund, maintain 3 to 6 months expenses. We may or may not need that, but it's a good to have. Now, there's a lot of talk about diversification and what does that look like. This is a very convoluted, I mean, well, there are lots of colors on this chart, but I'll tell you what it means. I will ask you to take a look at the top line. Um, for every column, 2015 going to 2024, at the very top, you would see midterm bonds, 2016 high yield. What's going on here is what you see at the top of the column is the best performing, call it an asset class for that year. Now, one question we get all the time is where should I be or what should I be in? And you'll see on this chart that it's all over the place. Nobody can predict accurately what you should be in. Now, this probably suggests that you should be in a little bit of everything because for 2025, we have no idea of what that's going to look like. We can take guesses, and there are times when we might be right, but you want a little bit of everything and the best of all the worlds, not just both worlds. And that's why diversity remains the word of the day. Now, Trevor is going to talk a little bit now about predictions and how that works.
Took my time rolling in because I love this quote. If it was possible, it's true, isn't it? If we had some ability to somehow see the future, then everyone would truly have wealth. And yet, you know this, not everyone does. So, what can you do knowing that it's not going to be possible to predict the future, and that probably losing sleep over the future? Like, did we really think Trump was going to do tariffs? No, no one had even thought about that was in the thing. Some of the things that the current president have done is like, I'm not sure that he thought anyone would get angry at Canada or that Greenland or the Panama Canal was up for negotiation. It's very strange. So if we know that we can't predict the future, there is some takeaways that we want to leave you with before we go to questions. What's your goal? What's your goal? Is it retirement? Is it saving for a home? Is it saving for your kids' education? I was just reviewing a client's education savings plans with them today. He was happy we have an undergrad covered. Once you know what your goals are, you can start sort of again connecting the blocks, so to speak, and saying, hey, am I working towards that? Is that going to allow me to achieve that? And that's the primary part of what should drive good financial decisions. We talked about diversification, but has been a year that has been interesting. Wally was saying that adjustments were already happening last year within portfolios. They were underweight in the US by about 1 or 2%. They didn't have a crystal ball either, but they just said the US is relatively high versus the rest of the world and other stock indices. And now it's kind of come home to roost. Oh, the best advice if you want to sleep well and keep your sanity, please ignore the headlines. Remember, remember when we were during COVID and like the COVID broadcast could take up to 20 minutes of a news report. Well, COVID's kind of finished, and yet the news hasn't shortened by 20 minutes. There's always going to be something, and it's always going to be sensational, and it might be very relevant, but it doesn't tend to stick for very long. I talked about this previously, paper losses versus real losses. Actually, right now, most clients actually haven't even lost money this year. If you go into your client view at IG, it actually will have your return calculated this year up to yesterday. Brand new feature. It's beautiful. And actually, my mom was talking to me. She's a client. She's better than my wife. Just so you know, guys, she's much gentler. If my mom's on this call, sorry, my lovely wife, but mom's a nicer client. And she said to me, I actually made money this year. I said, you have so far? She said, oh, I was thinking it was going to be carnage when I clicked on my client view. It was not. And I think that's interesting sometimes even to say, go in, look at your investments. Are they down slightly? If you have a heavy US component, they might be, but it's probably not the time to sell that. In the future, diversification would mean maybe, as Wally said, go down to 20% of your holdings in the United States into the future. And I think that will make you a lot happier. So stay focused on what the goal is still the primary thing, and ignoring a lot of the media will keep you saying, tariffs are short-term disruption. No one's enjoying this. Not even a little bit. This is not anybody's idea of fun. What is currently going on in the world is the opposite of fun. But even if the tariffs go into place, they will adjust in about 1 to 2 years. Okay. Long-term effects, geopolitical event is not going to affect your portfolio long term. But geopolitical events are going to continue. So in a year or two, we'll be talking about something else, and it'll be as relevant. And a lot of the strategies that we'll share with you will be the same. If you're working with a planner, hopefully our team or someone maybe encourage you to reach out to our team. A well-constructed plan, actually, we run through some of these, what we call them what if scenarios, and sort of say, hey, if the market corrects, can you handle that? What if there's inflation and runs higher? And running through those what ifs wherever you are just sort of says, oh, I can feel a little bit better because we know that the storm is not going to continue, which is terrific. I hope you've gotten some takeaways actually from our presentation today. I'm just going to pause my recording. Stop my recording.